GameStop soared by 80% in one day. And it's not because GameStop is a good company to invest in. Actually, it's a bad company to invest in at a fundamental level. And for this very reason, the stock went up. And this sounds confusing. What happened is that GameStop experienced a short squeeze. So for a very temporary period, the price went up and then it came back down. But now here we are today. GameStop has soared again, above 90%, up 680% in January alone. So in this video, we're going to cover number one, what a short squeeze is, and number two, why stocks like GameStop continue to pump even though the short squeeze has ended. Welcome aboard the Bitcoin Express. My name is Chase. Let's get to it. First things first, let's cover what a short sale is. Let's take a look at the drawing board. A short sale is performed when someone thinks that the price of an asset, or in this case, a stock, is going to go down. So this is how it works. Let's say person one thinks the price of a stock is going to decrease. So they borrow a share from person number two. Let's say this stock is trading at $10. So they borrow one stock at $10. At a future date, person number one will have to give back that one share to person number two. Now, in the case of a short sale, this is what is supposed to happen. Person one borrows one share from person two, worth $10. Now the stock drops from $10 to $5. So now that the stock is only $5, person one buys it back for $5, that one share, and gives it back to person number two. So in this case, person number one made a profit of $5. In this case, you're not paying back the amount of money you borrowed, you're paying the amount of shares you borrowed. So if you borrowed if you borrowed 10 stocks, you pay back 5 or 10 stocks. So where this goes wrong is, let's say person one borrows a stock from person two, thinking the price is going to drop, but instead the price goes up. Instead of going from $10 to $5, the stock goes from $10 to $20. Person number one still needs to repay person number two with that stock. So to cut their losses, they buy it back, let's say at 20, and they pay person number two. The longer they wait, the more risk there is. Let's say the stock goes from 10 to 20, then 20 to 30, and 30 to 40. The more it goes up, the more the short seller is going to lose. So in the case of GameStop, this is what happened. Many people thought, or they believed, that GameStop was going to go down due to the poor fundamentals of GameStop. So they borrowed shares to sell GameStop, but instead of it going down, it started to go up. And in order to prevent any further losses, all these short sellers, there were many, they bought back those shares at a higher price. And in a very short period, this caused the price of GameStop to skyrocket. But like most short sales, it was temporary. We can see when this happened. On that date, the price went up to about $144 per stock, and then it came crashing right back down to $68, $69 per share. So we would think that's it. It's over. The short squeeze happened. But GameStop continues to soar, and it is up again over 90%. Why? Because of Reddit, Twitter, TikTok, and Elon Musk. What I mean by this is that social media has taken over the retail investor. Retail investors, we thought, had no say or effect on markets. And this was because 10, 20 years ago, they didn't. There was no access to these markets. There was no Robinhood. How was an 18-year-old or a 20-year-old supposed to enter the market? Now in the present, we have all of these applications that make it so easy and simple to use. And after Robinhood introduced zero commission trading, other companies have adopted that as well, and they're also offering fractional shares now, so that really anyone can buy a stock. You don't need $200 to buy a stock. You can buy $10 worth or $20 worth. And because of this, retail has actually been causing the price of stocks to go up. Now, this is not a good thing. This is a very dangerous thing, I would say, because this is not investing. This is gambling. But this is how it is, and I understand that I'm not going to, think how things should be, but really just look at the way things are. So Elon Musk goes on Twitter and he says things like this: GameStop, and the price of this just skyrockets. He's done this with Dogecoin as well. So we have all of these people going on all these social media platforms, and we saw it also in 2020 that Robinhood traders, they pumped the Hertz stock by 100%. Hertz went bankrupt. It almost seems that in 2020 and now 2021 moving forward, The key to get a pump on Robinhood is to go broke and have bad fundamentals, because the people jumping into these aren't doing any research or technical analysis. They're just looking at social media, which you can make the case is a new form of technical analysis. We used to always think technical analysis is charts, just looking at the numbers. But we never really had the amount of social media that we have today. And whether we like it or not, social media influencers, they do influence the price of these stocks and even of cryptocurrency. We see with TikTok that TikTokers have started challenges to pump up Dogecoin, and it has worked. And it's not going to end here. This is the future that we're living in now. Social media influencers, people that aren't even doing any research, can say, I'm buying this stock, go buy the stock, and it can pump. And one of the best things I ever learned in the books that I've read is from Ray Dalio's Principles. And he speaks in the book saying that in life, don't focus on how things should be, but instead focus on how things actually are. For example, instead of saying Tesla shouldn't go up, GameStop shouldn't go up, accept the world that we live in, accept how it is, and it will definitely be more beneficial for you in the future. I hope that you found value in this video. Like this video, subscribe to the channel. Thank you for listening, and I'll see you next time.